Hi there, and welcome to another episode of the People of Private Capital. Today I speak with Greg Papazian. Greg is a recently retired managing partner from Brookwood Financial Partners based in Boston, a real estate private equity investor over many years. Greg shares with us his 33-year journey with Brookwood, what originally interested in the real estate sector, some of the deals that Brookwood have engaged in over the years, and brings us right up to date with their current and most exciting investment in Yesway, a gas and convenience play. Tremendous insights from Greg over his decades of experience with Brookwood, before, during, and what's next for Greg. So sit back and listen to this very engaging conversation with Greg Papazian here on the People of Private Capital. All right. Well, Greg, we covered a lot in the conversation, as I covered there in the intro. I did want to start with that news of your recent retirement. You're recently retired from the private equity sector and from Brookwood, where you spent the majority of your career. But we'll cover that career in some detail in this conversation. But first of all, welcome to the People of Private Capital podcast.
Thank you. It's good to be here.
Yeah, great. It's been a while coming. We've known each other for the last, I guess, 4 or 5 years. Full disclosure, you're a client of ours, and hopefully a happy client. Or Brookwood Financial Partners, a happy client. But we've had the opportunity to spend some time together and make some observations in the industry over recent years, as a lot has changed. And again, we'll cover that as well. But I wanted to, for people who are unfamiliar with Brookwood and certainly unfamiliar with you, Greg, just maybe start with a quick introduction to, who you are, who Brookwood is, and maybe the market that Brookwood's focused on during your time there.
Sure, great. Well, thanks for that. As we mentioned, I am recently retired from Brookwood after almost 33 years with the company. So I was there at the beginning when Tom Turkle founded it back in 1993. And the genesis goes back even further in that I met Tom at a company called Brookwood Financial Associates, which was very big in the late 80s and early 90s in tax shelter real estate transactions. And Tom left that company just a year after hiring me there, and started Brookwood as an alternative that wasn't really required or didn't require or was dependent upon tax shelters to make economic real estate investments for people attractive. And so he started up, invited me to come join him, which I happily did. And, Brookwood at that time was really a real estate private equity investment platform for high net worth individuals. We earned our business a couple of million, 3, 4, 5 million at a time, depending on the deals. They obviously got much larger over time. And really focused primarily on that high net worth individual for the first 10 or 12 years, I guess, and did a lot of individual real estate transactions. And the company has grown since then to, I think we've done now $4.5+ billion of total assets on over 2.5 or $7 billion in equity over what is now 33 years. And have diversified beyond just real estate into some operating businesses, Yesway, the gas station convenience store chain that I'm sure we'll talk about down the road here.
Yeah.
So that's it. And as you mentioned in your intro, I did retire from the company on August 21st. I'm still a minor equity partner in the firm and follow it closely and a big cheerleader. So that's where we are.
So 5 weeks into retirement, Greg, and this is the first opportunity that I've had, and you're still a young man, but it's the first opportunity I've had on I guess this is the 18th or 19th episode of the podcast, to interview somebody about their life in the private capital sector, which really, you mentioned 33 years, like it is a lifetime. It's a career in the private capital sector. Probably not. It's well understood now, and becoming even more well understood as it becomes democratized to a much broader base of potential investors. But at the time when you first joined that with Tom, like paint the scene for your outlook at Brookwood at that time. What were the ambitions, and I guess also to the extent you can talk about the scale of it, you were dipping your toe in what was a relatively new asset class, I'm guessing.
Yeah, it was interesting. As I mentioned, myself and a couple of my partners had come from the tax shelter world. Back in the
Yep.
late 80s, there was a huge run up in real estate because of accelerated depreciation on assets. You could invest in an office building that theoretically had a good business plan, but also offered a 3, 4, or 5 to 1 write off on your equity in the first year you did it.
Right.
So, at that point, they were order takers from accountants everywhere, just trying to get write offs for their customers. Um,
Yep.
but and of course, there was a big crash in late 87, 88, and that really kind of lingered through to when we started Brookwood. We were there coming out of the S&L crisis at the time, and the real estate was went through a very big shakeup, and
Hmm.
we wanted to get into it. We were real estate operators, pure and simple. We
Right.
were not really financial facilitators, myself and my partners, Tom especially. And we
Yeah.
wanted to operate real estate as an alternative investment. Right now, everyone's looking at alternative investments. Back then, it was a much
Hmm.
smaller niche offering, but you wanted to work
Yep.
with high net worth folks who always appreciated real estate as a part of any wealth building exercise. And we wanted to
Yep.
offer this sort of direct slash indirect ownership, limited liability, obviously ownership in these assets, and bring a value proposition to them as operators. So we weren't just placing their money; we were really doing really everything. We run the properties, we buy the properties, we put the debt together, we do the leasing, we do the abstracts. Really, everything at Brookwood is done by Brookwood except for tax returns and audits.
Right.
Uh,
Right.
so,
Right.
so the market then was much different. We really had to explain it to a lot of people, and when we did, we got good attention and good audience. We started in a very modest setting. We were trying to raise. I think our first deal was $4.9 million, and it took quite a while to raise that as a new
Yep.
company. But we were able to get a lot of traction over those first whatever it was 10 or 11 months, and launch another deal and another deal. And one of the biggest challenges in private equity investing, especially in the illiquid nature of those investments, is you have to earn people's trust over time. And so
Yeah.
we were fortunate to be at a time when there was a lot of value creation early on. We were able to turn some deals over and really show people what we could do. And the rest from there just sort of built over time on that momentum.
Yeah. Well, it strikes me, and you'll relate to this because you were, a tremendous supporter, continue to be a tremendous supporter of asset class over the years. And the expression "the hardest lift is off the ground," right? Those early days when you're trying to get that initial momentum, and as you say, the 4.9 million target, and was that a single asset investment? That right? Okay, right. You never forget your first deal. Huh? So that's how challenging is that when you don't have a track record, right? You're a new firm. I guess you're relying on relationships and people who knew you from from your earlier days at Winthrop, and what did that look like?
It's very challenging. I mean, we were a brand new company. I mean, obviously, we had come from a huge, legendary company, Winthrop Financial, which had I
Yep.
think 6 billion in assets over its time, and that was back in the 80s when 6 billion was a real number.
Yep.
And but we were new, we were young. And not to mention the fact that we were offering real estate at a time when most people looked at real estate as a beaten down asset. So that
Yeah.
to a small, cohort of folks that really appreciate it, they think, oh, opportunity. But most people think, geez, real estate's had a hard time. Do I really want to be in
Yeah.
real estate
Like you
right
say,
now?
after the whole kind of savings and loans debacle, right?
Exactly. And the Resolution Trust Corporation, which was liquidating assets on behalf of the S&Ls, et cetera. So it
Yeah.
was challenging, Freddie. We were blocking and tackling. We had some relationships. We had some partners in DC that had pretty good networks that we were able to work with and meet people with. But it was really blocking and tackling. We were doing the blocking and tackling of sales work. A lot of outgoing messages and calls. Of course, back then it was before computers.
Yeah.
I'm
Yeah.
that old. I can't get over that. But it really was before
Your
computers.
Rolodex.
We were looking at
Yeah.
literally Rolodexes and index
Yeah.
cards and legal sheets and using old fashioned phone lines and just
Yeah.
really working hard. But it was a lot of fun. I mean, we were in there, work hard, play hard. We were in there 12 hours a day, 7 to 7, and we all knew
Yeah.
that if we could get this one deal done, we had something. The
Yeah.
opportunity was
Yeah.
very clear to us early on. It was obviously clear to Tom when he ideated the company before he even started it or invited me to join. But
Yeah.
there was definitely a void there that we wanted to be a part of, and so we knew what we knew what we had to do, and just worked our butts off
Yeah.
to get it done.
Just a quick interlude. I'm Freddie Roberts, CEO and founder at Asset Class. And at Asset Class, we provide software solutions for the front, middle, and back office of firms like yours in the private equity, venture capital, commercial real estate, and broader private capital markets. So check us out at assetclass.com. We'd love to talk. Now, on with the episode. And when you close that first deal and you've raised the capital, you've deployed it, I mean, how are you moving on to broaden that focus to get additional deals in the pipeline? And it does take time for that asset to, or rather your strategy to come to fruition, right? What were your strategies at that time in order to get that track record? Was it shorter term kind of outlook,
Well,
kind of?
Ferdy, is an interesting question because we were never really, and really to this day, Brookwood is not, but were never wedded to one specific sector or strategy. In other words, we weren't saying Brookwood is about buying shopping centers in the Mid-Atlantic. That wasn't our
Right,
ethos. Our ethos was more about opportunistic buying. So our
right,
second deal was buying a note on a Days Inn hotel in South Plainfield, New Jersey.
right.
I forget where that came from. I think it came from one of our original equity partners down in New York. Very shortly after we closed the first deal, a gentleman we all knew with a huge reputation from Winthrop, Tom Brown, came to join us, now the president of Brookwood Financial Partners and heads all real estate operations. And he really brought a tremendous network nationally of opportunities and brokers in different markets. So, we went from Mid-Atlantic Shopping Center to a note on a middle market, or really lower tier hotel in New Jersey, which was one of our terrific deals. It flipped in, I think, 11 months for almost a double. Then we went, I think our third deal was in Texas in a shopping center there. I'm going to lose track of which deal's which, but we bounced around from
Yeah,
Texas to Florida, back to the Mid-Atlantic states, et cetera. Interestingly, as a New England company, we didn't buy a single asset in New England until I think 2007.
wow,
So,
okay,
because it really wasn't about where we were and it really wasn't about anything. It was about finding, you know, real estate is a location-based business, as we all know. You
yeah,
can't outsource the corner of
mhm,
Maine and Maine to, India or whatever it is for back
yeah,
office. And so
yeah,
it's very specific, and we found opportunities in very specific locales and demographics.
yeah. And when you think about those early years,
Mhm.
uh, I mean, great when things go great. Sometimes these things don't go so great. Not necessarily talking about deal specifics, but um, are there sectors that when you look back and you'll say, I'm not going to touch that again,
Well, I can give you a very
or
specific example of a
yeah,
deal. So, sometimes you need some luck, and
hmm,
sometimes you can do all the underwriting you can do. You can be right about everything. Very early on, I'm going to get the years wrong here, Ferdy, but I think it was about 96 or 97.
hmm,
We had an opportunity to co-invest with what was then a very large developer in the state of Florida. Atlantic Gulf
right,
Communities, I think, was the name. I forget what they've morphed into these
yeah,
days. And they owned the last oceanfront developable lot in Jupiter, Florida, right across from the ocean. Beautiful site, fully approved for, I want to say, 270 condo units in 3 buildings. And we co-invested with them, and they were going to develop it, and we were going to be the co-investors. To that point, we had not done development. We really weren't seeking development, but this particular opportunity was very, very compelling to us.
yeah,
And it was all as of right. It was all fully permitted. When we raised the equity, we got to work and very quickly found that the market was actually moving more quickly than Atlantic Gulf had thought, in that the market wanted bigger, more luxurious units, and
right,
that was going to be a compelling way to go. So we went back to the community. I don't want to get too far in the weeds here. We went back to the
yeah,
community and said, "Hey, instead of 270 units, I forget what it was, 9 stories high, 3 towers, blah blah blah. Let's pull back the scale, the number of units down to, I think it was 230 or 235. We proposed. Let's lower the height, broaden the footprint, give you a lighter footprint for the community, because obviously communities want to be sure that things are
yeah,
reasonable." And let us move forward with that. Well, the community took the opportunity of us needing something to say, no, we want to go back to the drawing board, and basically stopped us in our tracks. Now, we could have built what was approved as of right, but we really wanted to make it the right thing for the right location. And I think it was a full almost 3 years of litigation, which on which we won on every point. So
yeah,
we were right. We were at the end. A judge ordered that we had to get the new plan, which the judge said, "Yeah, it's more reasonable. It's lower density. How can you say no to this?" But
right,
we lost 3 years, and the problem with
yeah,
that was, we had what was going to be, probably a 30 to 40% IRR anyway. But when you, in other words, from the day we started building with the judge's order, you probably make
Right.
30 to 40% of your money. But if you add 3 years to that, now we're 9 or 10% IRR. And
Yeah.
suddenly that's not worth development risk. So we had to flip out
Yeah.
of
Yeah.
that. I think we got our money back and a few dollars for a sandwich or something like that, and called no joy. And the developer that bought it from us did exactly what we thought they would do and made that 30 to 40% return. But for us, the
Yeah.
sunk time, killed the returns, and kind of had to
You're too
say,
far
let's
into
go.
it. Yeah.
Yeah,
Yeah.
exactly.
Yeah. Well,
So, so
this
we have
is it.
not
I
done
mean, well,
development since, by the way.
yeah. Well, it's true. It's a cliche, but because it's true. But you learn a lot more from those kind of mistakes than
Oh,
you do
absolutely.
from
Yeah.
some of the successes. Like I say, timing is important. The opportunity presenting itself. The network that you got and what have you. But yeah, you learn a lot from those types of mistakes. And so if we just kind of move the timeline, so we're in the 90s here, right? You're a number of projects into building Brookwood. Um, was that a path that you had seen yourself kind of progressing? Was that something you aspired to, from early in your career or even prior to that, like at college? Is this the
Oh,
path
personally,
that you wanted to take? Yeah.
yeah, I'll give you a little bit of the genesis story of how I got into this,
Mhm.
and it's not
Yeah.
remarkable, but it's, I think, unique to me. My college career was unremarkable. I studied political science at University of Massachusetts. All due respect to University of Massachusetts, which is a terrific institution, but wasn't something that I was going to build a career upon. And I
Right.
really didn't know where I wanted to go. A lot of my friends, I was born and raised in New York City. A lot of my friends went to higher Zoot schools and went right to Wall Street as a result of their activities.
Yeah.
And the investing world always interested me, but stocks and bonds and mutual funds never really kind of floated my boat. My family has owned real estate for a long time. My grandmother,
Right. Okay.
as an immigrant coming over in the 1920s, built her family and legacy on real estate. And so I was
Right.
appreciated real estate. I was a real estate broker for a while. And I found Winthrop Financial Associates by accident. I was working with another company at the time, a vendor to them, and I discovered what they did. And when I found out that they were doing the securitization of real estate, that was a light bulb for me. That put two things
Right.
together that had always interested me, but it wasn't stocks and bonds and Wall Street. It was the securitization of something that I felt a lot of passion about. So that's how I jumped into the sector. And then when we started Brookwood, it was just more of an opportunity for me to be a part of something new, be a part of something big. And I will tell you that now that I'm looking back as a retiree,
Yeah.
it was probably 2 or 3 years into Brookwood's life cycle where I knew that that's where I wanted to retire from, and I told anyone who asked me, that I just everything had come together: the people, the opportunity, the market, the successes, and the failures that we all work through, made a lot of sense to me. So it was very early on in Brookwood's life that I knew that it's where I wanted to retire from, and I'm obviously very gratified that that came true for me. But that
Yeah.
that became clear, and the path, the opportunity to offer real estate investment to, I don't want to say the masses because it really isn't, but to more people by chunking them down into bite-sized pieces, really, it called to me.
Yeah.
And
That's it is incredible to find that. Very lucky to find it that early on.
Mhm.
But when you do, when you find your slot, like it is extremely gratifying. I share that in the software sector. I've
Mhm.
always loved software. It is
Yeah,
great.
yeah. And I will say
And
that the clientele really was one of the most gratifying things. We
yeah,
really met over the course of 30 years now plus the most interesting people. That was really the most fun part, was
yeah,
the folks that could invest with us. Obviously, it was a high net worth environment. Turned out to
yeah,
be very interesting people and folks with whom I've built really tremendous relationships.
yeah. And as that team is growing, Greg, right? So in the early days, becoming a bit, more established, um, gaining that track record. Where did you find yourself slotting in? I mean, when a group of people come together, people tend to find either by design or just over time, hey, I've, particular strength in this versus that. Where did your role start to evolve, in your earlier days of Brookwood,
Well, I mean, really, it was really a pretty complete evolution. When I started with Brookwood, I was essentially everybody's assistant. We
right?
were, and as I said back then, it was live or die on what we were going to do next. So we were all in the same boat, rowing the same oar. But I had some other folks who were quote unquote brokers, a little more senior than me, and I was everyone's
Yeah.
assistant. I was working in 3 or 4 different markets for 3 or 4 different people, trying to get the meetings and doing follow up and things like that. And
Yeah.
then the deal I had with Tom when I went there was, I'll do that to get the company going and do whatever I can to help. If we succeed, I'd like to become, a more senior person or broker. And he
Yeah. Yeah.
obviously honored that. And so for the first, I don't know, 12 years or so, I was really just a customer service rep, a business development person of different levels. I think I started leading Brookwood Securities, which is the broker dealer that we own, Brookwood owns, to do the securities marketing through back in, I want to say, '05 or something like that. So I started doing sales management, et cetera, at that
Yep.
point. And then as we went through, the Great Recession, which was obviously a trying time for our industry and everything,
Yeah.
and Brookwood thankfully made some really good moves and decisions leading up to that, which I'm happy to talk about. But
Yeah.
then after that, as we sort of hunkered down for what was next, that was when I was given the opportunity to join the executive committee and the investment committee of Brookwood, where I've been since I think '09 or something, 2009 or 10 or something like that, and
Yep.
really expand my leadership role across really the whole company. And really part of the executive committee's charter is to oversee all departments and bring everything to the fore. So that was ultimately 6 of us that made the decisions to run the company. I mean, Tom
Yeah.
made the decisions, but we advised.
Yeah.
So,
Yeah. Absolutely. Yeah, and it's I mentioned at the opening that you know, we've known each other for a while here, and it strikes me that apart from the obvious depth of experience that you've got in Brookwood and in the broader real estate market, that there is that depth is important. Certainly, it's very useful during times of success because you know where to concentrate and even in an up market you can make mistakes, but crucially the experiences that you've learned in as you say the late '80s coming into the recession of '08 '09 and real estate being at the center of that, right? Um, how did you kind of manage through that very difficult period? As you look back, what were kind of critical things that you either did or concentrated on to help you with that,
well,
or
it
maybe even
was,
before then?
we were, that was really an important time for us, as it was for all real estate operators. We were one of the very few private equity and real estate firms that we know of that
Yeah.
sold everything we had purchased prior to '05. We sold before '07. And
Oh,
so
wow.
we
Okay.
were really net sellers in a dramatic fashion. And that really came through, I'd like to say it was genius, and there was certainly a lot of thought behind it, but
Yeah.
we were still trying to buy in 2005 and 2006. And what we were seeing was that there was some pretty stupid money coming to the table, spending more money than we would care to compete with on the buy
Yeah.
side. So the decision was made fairly easy for us to say, well, guys, if this is the environment, let's unload. And we did.
Yeah.
So we sold just a ton of assets, very gratifying, locked in a lot of terrific returns for our investors. And
Yeah.
really from '05 to '08, we're net sellers in a big way. We then, Brookwood sat out of the market for real estate for, I think, a total of 22 months. We actually had
Right.
a fund. We started doing some small funds, $50 million funds at the time. We had raised our a second one at that time. And after an acquisition for that fund in, I think it was May or June of '07, we sat out until December of '09. And we actually had funds available. We didn't send them back to investors. We knew as real estate folks that there was going to be a cycle here, and we wanted to
Yeah.
have some
Yeah.
dry powder ready. But we also said, we're not going to play down here at the bottom. So we sat on, I don't know, half of that fund, 20 or 30 million, $20 million or so, for about
Yeah.
22 months, just
Uh-huh.
waiting for the right opportunity to get back in. So we got back in '09, started buying again. And so that was very gratifying. In hindsight, it looks, brilliant. But it really, it was being disciplined. And on the buy side, one of the things that has always helped Brookwood be successful is to not solve for returns in a way that manipulates the underwriting. I mean, Tom did a very compelling speech back then. I think it was in '07 called The Nile ain't just a river in Egypt, or denial ain't just a river in Egypt. And it was about how people at that time were underwriting unprecedented increases in rental rates and market dynamics to make deals happen. And that was the environment into which we sold,
Right.
because we couldn't do that. We couldn't sustain or get behind that kind of underwriting. And so that's kind of how we got to the sell side of that equation. And obviously, a lot of folks that did that underwriting were left holding the bag.
Yeah. So you're yeah, as you've described earlier, and I'm not sure if this is still the case, but you're describing a firm that's really focused on opportunistic, investment. As you say, it's not. I mean, and that in itself, I guess, is a strategy. But rather than following strategies and seeking out deals that fit it, your particular criteria. Um, how would you? And you've touched on a little bit here, I guess, in some of your comments, but the overall. Uh, let's say differentiation between Brookwood as a firm compared to some of the other players that are out there? Like, are there a number of characteristics that are reinforced within the firm or have been over time to kind of differentiate how you approach things versus other firms?
Yeah,
Like, how,
sure.
how would you characterize that?
Well, I think, we have always been an entrepreneurial group. And that was obviously true when we started the company, because we had to be entrepreneurs to start the company. But that ethos persists to this day. I mean, one of the great
Yeah.
things about Brookwood is, it's now a much bigger company. I think Brookwood is currently managing 2.7 billion or so of assets. As I said, we've done almost
Yeah.
5 billion over time.
Yeah.
And we do it all ourselves. I think we've got about 110 employees. We've got offices around the country for property management and securities and other things.
Yeah.
But we try to maintain that entrepreneurial and family atmosphere. It's a very intimate atmosphere for such a large
Yeah.
company. It's not unusual for folks to have a lot of direct communication with Tom Turkler, for example, or Tom Brown. They're always available. They get in the trenches. They want to do these things, and keeping that going really makes a difference, because you can work hard and you can play hard. That's always been the ethos of Brookwood. We have a good time, we buy a lot of lunches, we have a drink at the end of the day, whatever it needs to be. It's a family atmosphere. We support people in their needs personally if they've got a sick relative or whatever it is.
Yeah.
That's always the first thing in terms of our ethos, or the ethos of the company, knowing that the backdrop is working our butts off.
Yeah.
We really don't shirk on that. And Tom Turkle is the one who puts in the most hours to this day. I will tell you.
All right.
And
Yeah.
I guess that, and to get back to your question specifically, as operators and not just financial facilitators, we obviously take full responsibility for what we're investing in, but we also have a broader perspective. We know where additional levers might lie for value creation, for example, or market opportunities. And so by doing that, we really keep our fingers on the pulse of everything that we're doing. And so I
Yeah.
think that's what differentiates us to that extent. As operators there, we've also done changed our focus over time, as with our Yesway and gas station investment thesis, which has really brought us to a new level of operational opportunity.
Yeah. To the extent that you can talk about that,
Mhm.
can you share a little bit about that? Because that's fascinating. I've
Yeah,
had
no,
some
I'm happy
insights,
to.
obviously, working with you guys, but
So
yeah.
as we discussed, coming out of 08, 09, 2010, it was obviously a difficult time. We started buying again. There were certainly opportunities. Interest rates started moving in the direction of that we wanted them to, but we also knew that as true value real estate investors, you can't be investing all the time. As I said, we sat out for 22
Mhm.
months, because if you're investing all the time, you're subject to those dips.
Yep.
And so we set out on a course to evaluate the markets and see, well, what else can we invest in? What can we do that maybe is countercyclical or not subject to the same cycles as the real estate that we've kind of built the company on? And at that time, we hired Mark Daniels, who is now the chief strategy officer of the company, and his primary focus, along with some other folks and analysts and executives that worked with him, was to do an evaluation. And over the course of, it's a very interesting, detailed story. I won't get into the details of it, but over 3 years, really almost 3 years, he and his team evaluated hundreds of different sectors, businesses, opportunities. I mean, pallet manufacturers and onion distributors, and just sort of
Wow.
different business opportunities. And
Yeah.
when he got to gas stations and convenience stores, it was a very compelling sector and business, and B, it was a real estate anchored sector and business. So that gave us the kind of comfort to sort of, okay, we can put one foot on the dock and one foot on the boat in this
Yeah.
regard, because we know real estate, we know locations, and that's important, of course, in that business. So after many, many years of consideration, due diligence, back in 2015, we put the plan together, and we
Hmm.
launched the offering of BW Gas and Convenience, whose
Right.
entire business plan was to buy, operate, and grow a chain, a group of convenience stores and gas stations. And we started in the Midwest for all kinds of demographic reasons, right to work, the opportunity out there, fuel consumption, et cetera, et cetera.
Yeah.
And really leaned into that. We bought our first 10 stores in December of 2015, a small group of stores in Iowa.
Yeah.
And to this day, I can't keep track of the numbers anymore because we're building a lot of stores, which I'm happy to talk about. But we're about 440 stores in, I think, 9 different states right now.
Wow.
I think Yesway, which is the operating company we created,
Yeah.
is now the 14th or 13th largest operator in the country of gas stations and convenience stores. So very compelling opportunity, tremendous
Yeah.
business, and of course, it is also, as I mentioned, in our first couple of years, most of our deals were retail, and we moved away from that into office for a lot of years. But we understand retail, and
Hmm.
one of the controversial things about retail is, well, what retail is immune to Amazon? The Amazon effect and things like that.
Yes. Yeah.
And of
Yeah.
course, convenience stores are the poster child for that. It's not glamorous. It's smokes, it's cokes, it's lottery tickets, it's your morning coffee, it's your afternoon beer.
Yeah.
But that location driven dynamic for demographics and for people is really very compelling. Not to mention the fact that it's essentially a utility. People need the gas to move about their daily lives. And so really makes a ton of sense. And what we did then, as an operating business, as a private equity firm, was we said, well, let's not just buy gas stations and own them and let other people operate them. Let's actually
Yeah.
build the operating company. And we
Right.
put together the brand of Yesway, and we put together some expertise from outside and brought them in, industry operatives for operations and fuel and merchandising and marketing. But we, as an executive team led by Tom Turkle as the CEO, run the company.
Yeah.
And that's how we differentiated. We don't know of any other private equity firms that are really building this as operators. And so that's really been very gratifying. And as I said, the growth has been spectacular. And that's a company that, is now looking for an exit, either public or private. I
Yeah.
can't talk about any details there, but, it's
Sure.
been almost 10 years, and it's been a tremendous success operation.
That's incredible. And so it started with that concept, that deep analysis. You're going out and you're acquiring, I guess, groups, smaller groups, bringing them in under the Yesway brand, and now it's progressed to the point where you're actually building, operating. I mean, almost completely vertically integrating. Um,
Exactly right,
you know,
Freddie. I mean, we
you know,
started with acquisitions because we
yeah,
needed to build some critical mass and build a brand and build some geographical concentrations. And in 2019, we had the opportunity to buy a very large operator in West Texas and New Mexico called Allsup, a classic mom and pop empire that started back in, I
right,
think, the 50s or 60s with their first convenience store and grocery, and kind of pioneered things like self-serve pumps and things like that, and built up to,
yeah,
at the time, I forget the numbers exactly, Freddie, but around 310 or 320 stores, and with a legendary brand in that part of the world for their their deep fried burritos, their food service
yeah,
opportunity. So that was a great opportunity. We did a new round of investment in 2019, put the money, the debt, et cetera, together to buy Allsup at that time, and really got the momentum to expand into a bunch of new states, et cetera. As a result of operating that chain with ours, we were able to develop better efficiencies, more operational opportunities, better margins, better gas margins, et cetera. And what we
yeah,
found was, especially under the Allsups brand, because of its pull and its draw and its legendary status, we could now build stores that really had a head start out of the box. So, one of the challenges you have in developing a new store,
yeah.
especially under a new brand, is the J curve. You invest all this money and you've got to wait for the business to build. Well,
The
under the
footfall and
Allsups
yeah,
label, we started by redeveloping some of their existing real estate and then going into new real estate. And we could pick and choose different locational opportunities, expanded to certain states. We had a whole army of people crawling
yeah,
through our regions to find the right location and develop the opportunity to put an Allsups in. And when you build one and open it, especially in that part of the world, a lot of the initial marketing is already done for you by the brand's awareness.
yeah,
So
yeah.
very gratifying, and that's the primary growth engine at this time. is building
That's
stores.
phenomenal. I wasn't aware that you were uh, involved to that extent, that you were operating and actually managing the operating business.
Oh,
That
absolutely.
is phenomenal. It's quite unique. At least in the PE space, from what I've seen.
It is, as far as we know.
Yeah.
We are, we're
Yeah.
looking at we have the CFO, the controller, as I said, all the heads of merchandising and fuel, and everyone reporting up to Brookwood, and Tom Turkle is the CEO. Tom Brown is now the president, or the chief real estate officer there, and heading the development there. And so, yeah, it's been very, very gratifying, and we've taken a lot of control, all the control. We've taken responsibility, and the
Yeah.
numbers speak for themselves. I think I don't want to get into a lot of specific numbers because there's potentially some public offerings
Yeah.
in the
Yeah.
future. But at any rate, the numbers have continued to improve under our operation, and at the moment, the company's running very nicely.
Yeah.
Mhm.
Yeah. Fantastic. Well, that's great. Well, you're kind of bringing us a little bit more up to date here in terms of the journey. Um, I'm interested in your observations, Greg, around the market that we find ourselves in now, from a couple of different perspectives, interest rates, leverage, regulatory pressures. I mean, there's a lot that's going on in the broader real estate market. And I guess from a macro level perspective, first of all, how do you feel about the market conditions that exist? And maybe we could do a deeper dive into some of the subsectors of, because not all real estate is under the same pressure. There's lots of opportunities. There's certainly very significant pockets of opportunities that you've already referred to. But interested in your macro level kind of perspective right now.
Well, yeah, to be sure, and obviously that is no longer my day job. 5 weeks into
Yeah,
retirement, but we've Brookwood has really talked a lot about that over the last several years as things
yeah,
mature and the market gets a little wonky. We were very heavy in office when the pandemic struck, and we had a national portfolio that was just absolutely singing before that struck, and that's an example of a paradigm shift that seems to actually be a paradigm shift. You hear the term,
mhm,
oh, shifting paradigms, and eight
yeah,
times out of 10, there's no such thing. But obviously now, what are we, 3 or 4 months or years post pandemic? The shift is true. In the
yeah,
office sector, especially, we can't necessarily project demand very well right now in the office sector. Yeah, there's some pockets that are, really getting back. I think New York is reporting something like 70% utilization now, which is still
yeah.
below pre-COVID, but it's obviously coming back. But a lot of markets
Improving. Yeah,
nationally are still 50% utilization, not occupancy. The space is
yeah,
leased. Our portfolio is in the mid 70s on a leasehold basis, but in terms of
yeah,
people using it. And so, one of the things we talk a lot about is, well, we don't want to be in businesses where we can't understand or project reasonably the demand.
yeah,
Prior to COVID, projecting demand for office was a pretty straightforward, operation, especially with our experience and expertise. And so
yeah,
we're certainly avoiding that sector, although to be sure, opportunities will emerge there as well as things continue. The trend is definitely moving back in that direction. And so,
yeah,
you know, also informed by our experience with Yesway and gas and convenience, what we saw there was a tremendous impact of consumer driven demand. And as we know, I forget what the numbers are. I should have looked them up before this call. But the GDP of this country is, I think, 70 or 80% consumer demand and consumer
all
driven
right.
in terms of
Yeah,
spend. And so it's good to be on that side of an equation. As I said, with gas and convenience, very, very compelling opportunity, and something we'd love to do more of. But as we look out to what other real estate assets we want to get into, is we are still a large operating real estate company and want to explore whatever opportunities we can as well. We have focused more on the consumer driven real estate, what we call essential real estate. And so
yeah,
you can get into retail, but obviously you want to be very focused on things that are much more consumer dependent and specific to the location. Like grocery is the obvious choice. People still want to go out and touch their fruits and vegetables. Yes, there is delivery going on, but the delivery of those things, even the percentage of things being delivered from Amazon, as I understand it, is still below 20% of retail sales
yeah,
overall, and it's growing,
hmm,
but it's not. People might think, if they're Amazon Prime members, as I am, oh, it
yeah,
must be 80%, but it's not. And so we like the consumer driven real estate. We like consumer driven real estate related operating businesses like gas and convenience and other things that we really want to be able to get involved with. That could be, who knows what, car washes. It could be liquor stores. It could be any number of things. It could be medical spas or health related medical office buildings where you've got the
yeah,
consumer coming to the doctors, and of course,
yeah,
the other factor that we've seen dramatically shift through COVID is the demographic shift. You've seen a lot of people moving south, moving from the Northeast and California and the Midwest down to Texas and Florida, the poster childs for that. But the Carolinas, Georgia's
Yeah.
expanding, Arizona, etc. They're business friendly states, they're tax friendly states, they're warm and sunny, etc. And so you see a lot of consumers going there. So and that's a trend that's not going to reverse itself anytime soon. You've got the big baby
Hmm.
boomer bulge coming through and moving down. They're taking all their money with them. So you kind of want to
Yep.
be in sync with that. And so we've been looking at opportunities for what I'll broadly call essential real estate, really with a much greater focus on the consumer, the individual consumer as the user for that real estate. So that's kind of
Yeah.
what we're exploring at the moment. Yesway and gas and convenience is still a very compelling opportunity, and we might want to do more in that sector as well.
Yeah.
As that still proves to be, very, very strong. There's been a tremendous amount, in terms of M&A activity and investment in the sector internationally. I mean, just to get a little
Yeah.
wonky and industry specific, you had Couche-Tard, which runs the Circle K brand out of Canada, make a bid, which recently fell apart, to buy 7-Eleven, which is the largest brand on the planet, out of
Yep.
Japan. That was a $50 billion bid. So there's a lot of interest in the space.
Yeah.
Yeah.
Yeah. Exciting businesses. I see. I'm actually quite sure where Apple Green are
Hmm.
if you're familiar with that brand,
Yeah, sure.
same sort of thing, like huge growth, incredibly
Right.
acquisitive, and
Right.
yeah.
People are
Any
people.
other bright?
Well, I was just going to say, people keep realizing, coming back to the gas station and convenience store sector. And of course,
Yeah.
right now we're dealing with some societal and political sort of pullback from EV and things like that. There's no
Yeah.
bad news in any of that for this sector. Not
Yeah.
that it really needed it, because it was doing very well on its own. But people, investors, private equity, and operators realize that there's a lot of great margin opportunities in those business, and from a very compelling societal needs standpoint. You've got the fueling aspect, but that's not really where you make your money. You make a lot of
Yeah.
revenue there, but you make your profits in the convenience store. And if you can merchandise those things correctly for your location, you can really have a home run.
Yeah.
Mhm.
Yeah. Any other bright spots as you look at, so you mentioned obviously the kind of gas convenience sector, which you guys are in a big way, but um, any others that are maybe even surprising to people that are either having their day or making a comeback?
Well, I think, as I said, retail to us is attractive in certain markets, and that's really
Yeah.
demographically driven. As I said much earlier on, real estate is a local business. And so it doesn't have to be a national trend. You hear about the national trends. The biggest ones are being data centers. Everyone's talking about data centers, the big AI move. There's a tremendous amount of money being poured into that space, which makes it a good investment, but a very much a commodity space. You've got the bigs,
Hmm.
the
Yeah.
Apollos and the Blackstones pouring, tens of billions, or whatever the number is, hundreds of billions of dollars into that space,
Yeah.
and good on them. I think that this expansion of the alternative investment universe is great for everybody. The big players are going to become, I think, commodity offerings for private investment, which is fine, because a lot of
Yeah.
investors and family offices and institutions are interested in keeping that private space growing in their portfolios. The public space is kind of shrinking. There are far fewer public companies available today than there were 10 years ago and 20 years
Yeah.
ago. And so
Yeah.
that's great. Uh, Brookwood, as a smaller operator, really has to maintain its nimble approach and its opportunistic ethos, so that we may look at a shopping center in suburban or the mountains outside of Phoenix, and we may go to look at one in the mid-Atlantic states and look at a small medical office building in Boca Raton. And so that's the kind of thing that we continue to maintain, that entrepreneurial ethos, and let's look where the specific opportunities are. As I said, consumer driven is really kind of a focus right now. But we're not really going to get caught up. Brookwood isn't in the big, big, big trends, the industrial space, the data center space, et cetera. We're really going to stay below that boil and find what else we can pick off where there's not that kind of competition.
Yeah. One thing that strikes me, Greg, for opportunistic investment purposes, let's say, and this might be an obtuse question, but when you look at different deals, and they may be in different sectors, or I mean, broadly related to real estate, but maybe in different sectors. Are you looking for, do they share common themes or threads? I mean, obviously, consumer seems to be a common thread that you look at, or things that, there are three or four things that we look for in every deal. And to that extent, they are very similar deals. The reason I asked the question is I spoke with a PE firm, in recent months, and they invest in, when you mentioned that onion distribution, I mean, these guys invest in, pet food. They invest in forklift manufacturing, and it's all over the map, quite literally and figuratively speaking. But the one of the founders came from an accountancy background, and he looks at it really. He said, like I could judge the deal by kind of really looking at their books and seeing if it kind of fits our criteria. And do you have a similar kind of approach, or had you at Brookwood?
Yeah, we do, Ferdy, and it's not just a blanket guidepost that you can apply to anything, but being raised in real estate, there are certain metrics that are important. Cap rates are one. Real estate typically trades on a cap rate, which is a rate of return based on current income from the properties. But
Yep.
as operators, we looked at that plus other opportunities where what other levers can we pull and push? Now, in real estate, there aren't as many levers in terms of maybe there's
Right.
percentage rent, maybe there's an opportunity to lease a pad to someone, maybe you can put up an antenna and sell an antenna farm to someone, or signage, et cetera. What we
Yep.
love about the opcos is there are so many more levers to pull and push upon. It all comes down to the same analytics. We've got to, at the end of the day, we have to have a compelling opportunity for our investors that can produce either compelling income today and or compelling upside tomorrow, based
Yep.
on reasonable expectations. So, you know, I wouldn't say it's cookie cutter because it never is, because we're always very specific. But
Yep.
underwriting is underwriting, and you've got to have you've got to have the expertise or be able to access the expertise to understand any new business. It took us
Yep.
a long time to wrap our heads around gas stations, and very
Right.
much like, just as a tangent, very much like when we started that first small shopping center back in 1993, it took us a long time to earn people's investment on gas
Yep.
stations. So that was a long slog, that first slug of equity. In that, when we went to raise the second slug in 2019, it was much more gratifying. And now we can go to the market and say, guys, we may not have been operators then, but we certainly are now, and here's what we have to prove it. So Brookwood has proven that it can stand up an operational business in an area that is not necessarily its forte at the moment. And so that to us is a model that we want to exploit and expand upon.
Yep.
We're still going to be somewhat agnostic and say, well, it doesn't have to be gas stations. It could be car washes. It could be all the things we just discussed. But we can now hang our hat on our ability to not necessarily know everything, but know where to find it and know how to hire the right expertise and know how to govern that entity once it's up and running. So that's kind of how we look at things. But
Yep.
no two deals are alike, and that's what we love about the business. Frankly, if they were, there wouldn't be a business.
Yeah.
If this was an efficient business, it wouldn't exist. And
Yeah.
that's our ability to bring expertise and value to the table.
Yeah.
Mm.
Well, it certainly keeps things exciting,
It
and
does. That's what's great about it. It's
encourages
always something
lifelong
different.
learning.
Yeah, exactly right. And that's,
Yeah.
again, getting back to what we talked about early on, the stock and
Yeah.
bond and mutual fund, great space is really interesting, but everyone had the same thing. You had to make
Yeah.
different calls on it and trades and all that stuff. But to me, what I love about Brookwood and most gratifying for my whole career was it was always something new. Every asset was something new.
Yeah.
And that's the
Yeah.
fun.
Yeah.
Yes.
Absolutely. Well, one final question, Greg, before we kind of switch gears to talk a little bit about what's next for you. But your focus is clear based on the discussion that we've had. When it comes to investors in Brookwood, in your projects, your opportunities, uh, to what extent are you supportive of the retail investor versus institutional investor? How important was that to you as part of your kind of model for growth? Can you talk a little bit about that?
Sure, I can. Listen, it's an obvious segue to talk a little bit about your company as well. But as I retired as the chief investor relations officer among the several titles that I had, and that's really the most important thing. earning business from existing investors is the easiest way to earn business. To earn new
Hmm.
business is always a much longer cycle, a much more longer process. So you want to take care of people and make things as frictionless as possible in this business. And that's really been the
Yeah.
struggle in our industry, as you well know. Your product answers this question, this is not meant to be a shameless plug for you, but
I appreciate
in
it.
this, but it's a very colloquial business. Each operator does
Yeah.
its own thing. Again, unlike Wall Street firms that all are selling the same stocks and the same bonds and the same things, they have a lot of platforms put together. Each individual private equity firm, which are often smaller firms and entrepreneurial and trying to do their day jobs without necessarily focusing on building huge technology platforms, has
Yeah.
that struggle and that challenge. Brookwood has always erred on the side of over-reporting and over disclosing to investors. They do quarterly reporting. Every quarter, letters and checks go out to their distributions. There are follow-up webinars for people to call in and ask their questions every single quarter. And what we transitioned to with the help of Asset Class, thank you, was a more frictionless client-facing portal and a little more
Hmm.
transactional transparency there as well, where we can put up more
Yeah.
information, have the clients interact directly on their own behalf, because that's what customers really want now. A lot of the older
Right.
investors still want paper and still want phone calls and things like that. That's fine.
Yeah.
But the newer investors and the institutional investors certainly are looking for platforms that can serve their needs and serve their information requests and things like that efficiently.
Yeah.
Now, having said that, we've now become an institutional platform. I would say of our current equity deployed at Brookwood, it's got to be about 80% institutional investors. So that was a transition we
Right.
made back in 2013, I think was our first institutional platform servicing, the classic institutions and pensions
Yeah.
and endowments, et cetera. Um, they are also struggling with this, and I'm sure it's an opportunity for you and your firm because they have multiple platforms. So we get requests at Brookwood from Diligence Vault, and there's a number of different
Yeah.
providers that we as an investment house have to answer their due diligence questions and their audit questions, and they come fast and furious. And of course, in this regulatory environment, the audit process, there are 2 or 3 auditors on every institutional account. So
Yeah.
it becomes very complicated, and you really have to be very responsive to it. There's a lot to it. Something incoming request comes in, and suddenly I've got to get legal involved, and I've got to get accounting involved, and I've got to have an analyst run a different version of the numbers. And so,
Yeah.
but you do it because it's what, if you can do it efficiently and stay in touch with them and satisfy their needs, which are oftentimes regulatory and stuff that they may or may not care deeply about, but have to check a box on, you
Yeah.
want the investor to always say, hey, Brookwood is easy to deal with. That's what we want
Yeah.
to see. If I don't have a problem, if I reach Brookwood, they're going to take care of this ridiculous request that I got from an auditor and going to make me look good and feel good. That's really the focus. I'm kind of wandering on your question here, but really having that customer focused platforming and making it as efficient as possible. Just onboarding through a subscription onboarding online was new to us
Yeah.
a couple of years ago when we first started working with you. That's tremendously efficient, and now it's what people expect. So you
Yeah.
really have to stay involved with that. You just want to make Brookwood not a problem. It's just
Yeah.
make it easy. Brookwood's easy to deal with, and
Yeah.
that's all you want people to think about. Whether our returns are perfect or not, up and down, we get as much credit in down markets and investments that are struggling with our reporting as we do in up, because
Yeah.
people appreciate that we're doing our jobs, working our butts off, and telling them what's going on a regular basis.
Yeah.
Yeah.
Yeah. I mean, you could argue that they're often more interested when that's happening,
Oh, of course.
right?
You
To
get
try
many more
and,
when things are going perfectly, you don't get a lot of phone calls. People
yeah,
just cash
yeah,
their checks and say thank you very much. And
that's right.
that can be a struggle for some people, but that's our job. Our job is to work out the hard things. And
Yeah.
that's the trust we have, and that's the duty we take very seriously.
Yeah. Yeah. Well, I think you guys do a great job on it. You got a tremendous loyalty. It's clear over the years. I mean, just to be in business the period that you have been is something else, and to experience the kind of growth, all very well deserved. Um, I want to kind of just segue in closing here, Greg, to what's next. We've talked a number of times here about the fact that you recently retired, and I know just in speaking to you that there are a number of topics that are and causes that are close to your heart that if anybody is listening to this, maybe there's a connection that can come out of it. But yeah, just keen to understand, yeah, what kind of your priorities are now as you kind of move into this next chapter and enjoy some of the fruits of your success, but also pursue some of the passions of I guess your life.
Yeah, I appreciate that, Freddie. It's a lot of it is still unwritten.
Yeah,
I am truly retired professionally, and really very thrilled and privileged and gratified to be able to do so.
yeah,
But I do, one of the things I want to be able to offer and be involved with is the opportunity to help other people solve problems, basically.
hmm,
There's a bunch of causes I feel very strongly about, broadly called impact investing is sort of the umbrella under
right,
which a lot of these can be solved or can be addressed. But
yeah,
sustainability, social and economic justice, child and animal welfare, all very important topics to me. And I
yeah,
have been trying to explore this impact investing community and space, just to offer my expertise, my abilities, my time to some folks. And I've gotten some entreaties out there that I'm just discussing and developing. I haven't really made any decisions yet. And in a
yeah,
perfect world, I would help some young entrepreneurs that are trying to solve problems through the model that I appreciate, which is the
yeah,
capitalism and private equity model, where you do it through
yeah,
an investment strategy. So let's solve the problem. Let's make a few bucks along the way. Let's have it be an economic engine that, we're not just looking for the government to solve, but we want to come in and solve housing in
yeah,
Baltimore or sustainable energy in Canada or wherever it is. And so,
yeah,
again, I haven't really fully painted this picture yet, but that's where I'm really focused. I want to be available to, I want to be in service to causes that I care about, and the extent to which my expertise in underwriting or document review or finance or fundraising can help some groups. I'd love to do that on a pro bono basis and just be
yeah,
able to help some folks, do some great things.
yeah, yeah. Well, it's wonderful to hear, and doesn't surprise me in the least. Just in my time of knowing you, Greg, you're a tremendously sincere person, a gentleman of the industry.
Oh,
And
thank you.
I've had the benefit of meeting lots of people over, in from the early days of our business through to now. And the vast majority great people, but you really are a standout guy, Greg, and I wish you nothing but the best for your retirement, and hopefully our paths will continue to cross here post retirement. And anybody listening who has the opportunity to take Greg up on his offer, I'd really encourage you to do so. Just a tremendous individual, and in your retirement, Greg, I wish you all of the continued success that you've enjoyed to date.
Well, I appreciate that very much, Freddie. Thank you for the kind words, by the way. I really do appreciate that. Likewise, I've always thoroughly enjoyed our relationship professionally, and now personally, we'll keep it going. I look forward to that as well. But it's
Yeah,
great to be with you and be able to talk about some of the stuff about which I care deeply.
absolutely. Well, thanks very much, Greg. Well, for now on this episode of the People of Private Capital podcast, Greg Papazian, recently retired of Brookwood Financial Partners. Thanks very much for joining us, Greg.
Thank you, Freddie. Cheers.
All right, take care.